I'm Sam Slator from Chelsea Financial Services, and I'm here today with Bryn Jones, manager of the Rathbone Ethical Bond Fund. Bryn, can you please explain your investment process to us?
Yeah, so the investment process for the Ethical Bond Fund starts very much with thematic investing. So we're looking for big themes that exist out in the real world, trying to monetize those returns, but also protecting investors from those risks that exist in the real world. We then sort of carry out strict credit research. So we're looking at what we call our 4Cs plus model. We're looking at character management, capacity to pay back that debt, collateral and covenants. And the plus bit comes from conviction. So we have to have a lot of conviction in what we do. And then after we've sort of done all the credit work, we are then looking at valuation to see if something's rich or cheap. There's no point buying something if it's overvalued. So we're looking for value in the bond market. And once we put all those processes in place, we have a negative and positive screening process where any of the negatives that are on our ethical screening are excluded, and then it has to have at least one positive. After we've done all those four things, we pick an asset and it goes into the portfolio.
What type of things do you screen out for negative behaviour?
So negative can be things like alcohol and tobacco production, pornography, gambling, environmental damage. So this includes car manufacture, mining, animal testing, predatory lending, are the main ones that we exclude out for. If it has any of those in terms of the way it makes money, then it's excluded from the portfolio.
And what would be an example of a positive screen?
Positive screen can be anything from good working practices for gender and racial equality, positive impacts to society and environment, big corporate community investment, so looking after the local communities, and that it has to have at least one of those positives before it can go in the fund.
And where are you finding opportunities at the moment?
The fund's always found opportunities in the non-rated space. If we think about a lot of funds out there that tend to buy benchmark assets, we like to look at things that are outside of that, where they don't have a rating. We can use up to 10% of the portfolio in that way, and we tend to use that budget as much as we can. We tend to find there's a lot of extra yield in that space. But also in terms of also avoiding areas as well. So this year we've over the last 12 months, we've reduced our retailers. The Amazon effect and the impact on retailers we think is negative for that market, and we've seen a lot of that this year with House of Fraser, Debenhams, Macy's in the US all coming under negative impact from the Amazon effect.
And you have 38% in bank bonds at the moment. A lot of our investors wouldn't necessarily associate banks with ethical investing, so can you explain that a little bit, please?
Well, firstly, there's nothing specifically in our mandate that prohibits us from investing in banks. I mean, they're not getting involved directly in alcohol or tobacco production. They might lend to companies. But what's interesting, when we look at the banks, we've been trying to see that kind of a best-of-breed approach. So, for example, some of the French banks now are actively disengaged with tobacco companies. Some of the French insurers are actively disengaging with fossil fuels. And so it's looking through that and trying to find some areas where we think that there's opportunities for investing to make money, and also what we think is on a more sustainable basis. But also in the insurance space, if you think about it, without insurance and banks, we would be in a very difficult position. If your house burnt down and you had no insurance, you wouldn't have anywhere to live. So there is some kind of social capitalism involved in insurance companies as well.
Thank you.